Welcome and thank you for joining us for another episode of KPMG's Inside International Tax, a podcast devoted to recent developments, observations, and trends related to U.S. international tax. I'm one of your hosts, Gary Scanlon, a principal in KPMG's WNT International Tax Practice. I'm joined by my co-host, Kristen Gamboa, a managing director in the same group. Hi, Kristen.
Hey, Gary.
On August 6, 2024, Treasury and the IRS released long-awaited proposed regulations that address certain issues arising under the dual consolidated loss, or DCL, rules. The proposed regulations address a wide variety of issues, including, amongst other things, the interaction of the DCL rules with the Pillar 2 globe calculation, and the effect of intercompany transactions and on items arising from stock ownership in computing a DCL. In addition, the proposed regs introduce a completely new and completely controversial set of rules, referred to as the disregarded payment loss, or DPL rules, which are an anti-hybrid regime that target deduction-no inclusion outcomes described in BEPS 1.0. In today's episode, we'll explore the practical implications of these rules. For our discussion today, we're joined by Doug Holland, a principal in KPMG's WNT International Tax Practice and a returning guest to the podcast. Welcome back to the podcast, Doug.
Thanks, Gary, and thanks, Kristen. Happy to be back and appreciate the chance to speak again.
So before we discuss the proposed regs, it's probably helpful to give our listeners a quick refresher on the DCL rules. In general, the DCL rules apply to NOLs of separate units, so foreign branches or hybrid entities, and dual resident corporations to prevent double dipping of losses. For example, where a single economic loss offsets income subject to tax both in the United States and in a foreign jurisdiction. Generally, the DCL rules would prevent a DCL from being made available to offset, directly or indirectly, the income of a domestic affiliate other than the dual resident corporation or separate unit that has incurred the DCL. This is known as the domestic use limitation. So importantly, in general, the domestic use limitation does not apply if the taxpayer makes a domestic use election, certifying that it will not use the DCL under foreign law against income of a foreign affiliate. If a foreign use or other triggering event occurs for a taxpayer while subject to a domestic use election, the taxpayer is required to recapture the amount of the DCL used against U.S. income, plus pay an interest charge on the amount. Historically, the DCL rules have generally come into play where the loss reduces or otherwise offsets income of a foreign affiliate under a foreign law consolidation regime. But the mandatory jurisdictional blending under the Pillar 2 globe rules has raised numerous questions regarding whether a foreign use could occur when a loss of a separate unit is used to reduce a jurisdictional top-up tax. In December of last year, Treasury released Notice 2023-80, which provided limited relief for legacy DCLs, that is, DCLs incurred in tax years ending on or before December 31st, 2023. Specifically, the notice generally provided that the globe rules will not create a foreign use of a legacy DCL and therefore will not create a triggering event for DCLs subject to existing domestic use elections. For more background, check out our episode entitled Notice 2023-80, FTCs, DCLs, and the Globe Rules, oh my, released earlier this year in February. So with that, let's talk about the proposed regs. So starting with the complications raised by Pillar 2, Doug, we know the notice exempted losses incurred through 2023, but what do the proposed regs do in taking up this issue of the interaction of DCLs and globe calculations?
Thanks, Kristen. So in the notice, the government had signaled that they were studying this interaction of Pillar 2 and the DCL rules and kind of considering whether they ought to treat the Pillar 2 taxes, which are largely book-based minimum taxes, on sort of a similar footing with the traditional corporate income tax systems that has been where the DCL rules have operated in years past. And kind of bottom line up front where they landed with the guidance is that to treat the Pillar 2 top-up taxes, at least QDMTTs and IIRs, they're still kind of reserving on UTPRs, but for the MTT and the IIRs, that those would be considered income taxes for DCL purposes, the effect of which being that when you had a separate unit or dual resident company that has a loss and it's combined within a Pillar 2 calculation, that gives rise to a foreign use and triggers the domestic use limitation that you went through before. And before we start unpacking all that, though, this is at least still a proposed and prospective issue. In one helpful part of the guidance, the government extended the legacy DCL status for losses incurred through 2024. And so this isn't going to really ripen into an issue either for financial accounting or tax reporting until next year for affected taxpayers. The one caveat to that is that transition or that extension is subject to an anti-avoidance rule where if a taxpayer incurred a DCL, and the magic words are with a view towards, not even just a principal purpose, but a view towards reducing a Pillar 2 top-up tax or qualifying for a Pillar 2 safe harbor, then the new rules apply and would disallow the use of that loss on the U.S. return. And that's effective for 2024 years. So for that scenario, it's sort of immediately effective, at least once these are finalized.
Thanks, Doug. So what about going forward? How do the proposed rules treat those DCLs that interact with Pillar 2?
So again, the big takeaway is that the rules treat the Pillar 2 taxes as income taxes for DCL purposes. And the effect of that is when you have a separate unit, which is a hybrid entity or a branch, combined within Pillar 2 jurisdictional calculation with affiliates that are treated as CFCs, that blending or tax consolidation in the Pillar 2 tax base is going to create a foreign use and mean that you're not eligible to make a domestic use election. In making that decision, Treasury and the IRS rejected comments from a number of trade groups and taxpayers that they should just sort of let this go, that Pillar 2 taxes were too book-based and too different from regular corporate income tax systems to really marry this up with the DCL rules. And, if the OECD wanted to pursue its own anti-arbitrage or anti-hybrid rules, which it's doing, that could sort of suffice to police this. But the government decided that that was not the approach they wanted to take, that they felt like, especially in cases where there actually was a reduction in the Pillar 2 income taxes, that there wasn't really, in their mind, a persuasive reason to distinguish the Pillar 2 taxes from regular income taxes. And so they've moved ahead with expanding the scope of the DCL rules to the Pillar 2 regime. But going back to something you mentioned before, where this has really sort of flipped the traditional way that taxpayers think about the DCL rules on its head, is that in the old days, or up until Pillar 2, the applicability of the DCL rules was really conditioned on the taxpayer choosing to have the separate unit or dual resident company join in foreign tax consolidation with an affiliate, whether that's through group relief or Gonchofts or fiscal unities in foreign countries. And with Pillar 2, that electivity is sort of taken away or just turned on its head through the mandatory jurisdictional blending. And so that's really where a lot of the consternation coming out of these rules now is that, as written and as proposed, this could lead to widespread disallowance of a lot of losses that previously had been fine for decades under the way the DCL rules operated. Now that's going to change because of Pillar 2.
So what if a loss is used in the calculation of a QDMTT or an IIR for a jurisdiction that's already subject to a sufficiently high rate of tax so that no top-up tax would be required, even if the separate unit loss were not included? Do the rules provide for any exceptions from the application of the DCL rules in this case?
The starting point here is that the DCL foreign use concept has, for a long time now, keyed off of when the loss and deductions of the separate unit or dual resident are just made available in the foreign income tax system, meaning they're just sort of combined in some kind of foreign tax consolidation. The government had justified this a long time ago that once you cross that threshold, even if there's not a sort of current tax reduction, there could be carryovers or deferreds or something else that could lead to a foreign tax reduction in a later year, and then it would be too difficult for them to track and audit and monitor that. And so from a sort of administrability standpoint, they needed to just kind of nip the issue in the bud and treat a foreign use as happening when the loss arose in the foreign jurisdiction, not when it was actually used, if that came at a later time. And so the proposed regulations keep that same framework and then just layer in the Pillar 2 taxes. And as such, they're not really asking whether an actual foreign tax reduction happens. It's just whether the separate unit with the loss is combined. And so this was probably the issue that was most commented on by the taxpayer community regarding these rules, that using the made available standard here in the same way is just too broad and sweeps in too many cases where there's no actual foreign tax benefit, and that Treasury and the IRS should provide something more tailored and more focused on an actual foreign tax reduction. Now, the proposed rules do have an exception kind of along these lines, but it's a little more limited and more involved. And so it applies if the taxpayer, and let's just use Canada, is in the transitional country by country safe harbor for Canada. And if you didn't need the separate unit or the hybrid entities loss to get down under the safe harbor threshold, they'll let it go. So that's very helpful for taxpayers that are in the safe harbor calculation, but it just sort of begs the question of why it was drafted so narrowly, especially when we've heard that the OECD is planning to sort of advance and expand the duplicate loss arrangement and other anti-hybrid rules into the full globe calculations with the next round of guidance that's coming at the end of this year.
That's really interesting. And clearly the application of these rules as they're currently drafted seems very broad. But given where things stand, what should taxpayers be looking out for?
Right. I think the main issue spotting that we've been helping our clients with is just sort of, first off, getting your hands around the scope of the problem, finding the countries where you've been filing domestic use elections for the 2023 filing season that just closed in prior years, and where you're forecasting losses in the future, and matching that up with, do you have constituent entities in that country that are CFCs, finding the 5471s there, and seeing where you might have a disallowance. And I think where we're seeing this a lot would be in some of the countries that maybe don't have regular consolidation, and you weren't thinking about this already, like Canada, Mexico, China, India, Brazil, those types of places. In terms of trying to play defense a little bit too, without covering everything in the DCL universe here, but just a reminder too that taxpayers can use DCLs to the extent that they've earned positive income in the separate units or dual resident companies in years past. That's sometimes called the cumulative register or surly register computation. And so going out and kind of hunting and reestablishing those attributes to use as a buffer here is something that we've been working with a number of companies on as well since these rules have come out.
Okay, so that covers the portion of the regs providing guidance taxpayers were more or less expecting. But let's talk about some of the rules that may have come as a surprise, starting with the DPL regime. Doug, can you provide a quick summary of what the DPL regime is trying to do?
Sure, Gary. Broadly, the DPL rules are acting on a recommendation from the mid-2010s BEPS 1.0 anti-hybrid report, action item 2, to disallow a deduction-no inclusion or D&I outcome when the U.S. is the parent jurisdiction. So the paradigm case here is, let's say you have a U.S. corporate group, they own a foreign DRE, say it's in the Netherlands, and the U.S. parent has lent money to that Netherlands DRE, the Dutch BV most likely, and so the Dutch BV is accruing interest expense that it's paying back up to the U.S. parent. And so that interest expense is disregarded from a U.S. tax perspective, but leaving aside sort of local disallowance, that you get a deduction in the Dutch BV for Dutch tax purposes, and there's no income inclusion on the U.S. side because the income is disregarded. And then let's say the Dutch BV owns another BV that's treated as a CFC, and they're in a fiscal unity in the Netherlands. You get the sort of double dipping there that the DCL rules were designed to prevent, but there's no loss there from a U.S. tax perspective because the interest expense in the BV is disregarded. So that's what it's sort of broadly aimed at, or at least sort of the most obvious fact pattern. Now, that of course doesn't work in the Netherlands anymore, or in other countries where that used to be a popular financing technique, because other countries were much quicker to adopt the BEPS Action 2 recommendations. And so this is in the European countries with the ATAD 2 initiative that came out 5-6 years ago, and the UK's anti-hybrid rules, the Australian and New Zealand anti-hybrid rules. So a lot of other countries have already enacted their own rules to deny the deductibility of that disregarded interest expense in that country as a first measure. Even still, Treasury perceived that this was still a gap in some of the guidance and decided to still act on it. But in doing that, the DPL rules have gone broader than what was in the BEPS recommendations. The DPL rules key off of whether there's payments of interest or royalties going out of the Dutch BV in that example that are deductible for local purposes and then not included for U.S. tax purposes. So that could be paid back to the U.S. tax owner or to a branch or another DRE of the same tax owner. And the rules don't turn off or there's no exception if it's included into income for foreign tax purposes. So, for example, that Dutch BV, if there was a French disregarded entity that was brother sister to it, and you made the payment from the Dutch BV over to the French DRE, you'd be getting a deduction in the Netherlands and income inclusion in France. And there's no real overall global tax difference for the group, assuming the rates are pretty equivalent. But that payment would still be caught by the DPL rules, even though it's fully subject to tax in France. So that's just a different outcome than where the BEPS report recommendations went, because they would say that the inclusion in France would make this not a DNI outcome, but the DPL rules are hunting for just no inclusion on the US side.
Okay, Doug, so there's no actual US income here. These are disregarded payments, and these don't seem to be predicated at all on the existence of a DCL. So having a hard time visualizing how these rules actually work. Can you unpack this for me?
Sure, Gary. Let me take a step back here. So the DPL rules require U.S. taxpayers to look at their U.S.-owned foreign disregarded entities, and also for kind of true foreign branches or PEs that make payments into commonly owned FDEs. So those are all together called specified eligible entities. And then look for payments of interest and royalties going out of those entities that are deductible for foreign tax purposes. And so the DPL amount, this is a new thing we have to track in addition to DCL, but it's a net calculation. It's the outflows of the disregarded interest and royalties. And then taxpayers are allowed to include disregarded interest and royalty income that comes back into the DREs. So it's really looking at the net amount of this disregarded financing or highly mobile income that the rules are focused on, very similar to 267 Cap A in the code. And then this calculation is done on a country-by-country subgroup basis, just like the DCL rules have with the combined separate unit rule. So if we get to the point where there is a net DPL, then just like with DCL, the question is whether there's a foreign use of the interest or royalty expenses within the DPL. And again, a foreign use means that those expenses are being used to offset income of a CFC or other affiliate within the global group that's not part of the combined unit. And if there is a foreign use, then the penalty here is that there's no loss to disallow from a U.S. perspective. So instead, the taxpayer has to include the disregarded payment back into income as a penalty. It's almost like the disregarded status gets revoked and you have to treat the payment as going back to the U.S. owner as if it came from a CFC. If there's no foreign use, though, then like DCL, you're into a domestic use election type regime where you have to file an election in the year the loss is incurred and monitor that for another 5 years with potential triggering events and recaptured down the road if there is a foreign use or if the taxpayer fails to certify the loss in a later year.
So, Doug, you said that the DPL amount is net of interest and royalty income. What if the foreign entity with the DPL is profitable from earning third-party income? Is there any relief there?
Well, maybe. So in that case, the third-party income, that's sometimes called dual inclusion income in the lingo of all these anti-hybrid rules. So that doesn't technically reduce the amount of the DPL, but where it can help is that it might offer some leeway on whether a foreign use arises for the DPL deductions. And in particular, there's an exception in the DCL foreign use rules that can be read to say that if those interest or royalty deductions would first be used to offset that dual inclusion income before being shared or made available with those other affiliates, that no foreign use arises. And that would sort of commonly come up if the entity was profitable from a local tax perspective. Essentially, the point is that if the entity doesn't have a net loss to throw into a foreign tax consolidation regime, its deduction shouldn't really be considered made available for an offset. And so, we and other advisors were kind of hopeful that that exception would provide some practical relief here, but I heard some noise on the government side that they're thinking about whether that rule is how it really ought to work here and whether they need to do something to keep track of whether taxpayers could be double counting the dual inclusion income for both DCL and DPL purposes, with the idea that it wouldn't be appropriate to let the same income free up both anti-hybrid rules. So that's something that they've gotten a lot of comments on as well.
So as I noted in the intro, the DPL rules were both unexpected and quite controversial. What authority does Treasury have to issue them?
That is the $64,000 question here. Where Treasury staked its claim is that they tied the DPL rules into the check the box election for the foreign DREs. And this ties very much into the effective date provisions for these new rules. So out of the gate, starting from when the proposed regs came out on August 6th, for a newly formed foreign entity that you file a check the box election, or for any new check the box election, the proposed regs would say that being able to elect disregarded entity status for that foreign entity is conditioned on the taxpayer consenting to the DPL rules. It's a new condition in addition to just the entity being sort of a foreign eligible entity on the check the box side. So that's for new entities and new elections. For pre-existing entities, there's a year of transition time here. The rules don't kick in until August 6th of next year. And after some clarifications, it seems that the government is applying this on an entity by entity basis. So it's a fairly novel approach and something that's arguably stretching the bounds of the check the box and their authority under 7701. And that's something that I heard quite a lot in the comments as well. It actually isn't the first time they did this. About 5 years ago, to address another anti-hybrid rule around domestic reverse hybrid entities, they put in a similar mechanism where making a check-the-box election for those meant that the entity was deemed to consent to the DCL rules applying. But those types of entities are just much less common in the taxpayer community, at least my experience. And so the fact that this had kind of already happened, this making a special condition on the check-the-box election, was not something that was kind of widely understood.
The DPL rules are obviously just proposed. Is there anything taxpayers should be doing to prepare for the finalization of these rules?
Yeah, I think, again, the main to-dos here are quantifying and getting your arms around the scope of the problem, which means identifying the entities that are specified eligible foreign entities and the outflows of payments for them, quantifying what the amount of potential DPL here would be, seeing if there's a foreign use, and then the next step would be considering restructuring alternatives, whether that's moving the entities offshore so that they would be under a CFC, or maybe making the payment flows regarded instead of being disregarded through a change in ownership. That's going to segue in a second into our next topic, but it is a little elegant now with the government having tied the strings pretty tight here, where it's all payments going out of these foreign hybrid entities are either regarded and caught by the DCL rules or disregarded and caught by the DPL rules.
Okay, so let's move on to some rules in the proposed regs that aren't quite so revolutionary, the changes to the intercompany transaction rules. What changed here?
So this was an issue that had been around for quite a while. And the basic scenario was the DCL rules have forever said that disregarded transactions are disregarded. So again, like with the DPL rules, but the other way too, where if you had a payment from a tax owner down to its disregarded entity, you would not include that income received by the disregarded entity in its DCL calculation. And so there's been this longstanding question about whether, if a similar but slightly different scenario, let's say you had a U.S. parent owned a U.S. subsidiary, and the U.S. subsidiary owned the foreign disregarded entity, and the DRE was providing services for the parent entity or group overall, and the parent was making a payment down to the subsidiary's branch, that payment is not disregarded for U.S. tax purposes overall, but it is an intercompany payment subject to the consolidated return regs and the -13 matching and redetermination rules. And I think the easiest thing to say is there was some healthy debate in the taxpayer and advisor community about whether those two scenarios should be treated equivalently or differently. And so where the proposed regulations landed on this was that these two scenarios would be treated differently, where the intercompany payments would be given effect, but disregarded payments are still disregarded. And the technical tie-in for that was saying that an entity who had a branch or was a dual resident had special status under the consolidated return regulations. So the effect of that being that you don't redetermine its items that are relevant for that special status provision, i.e. the domestic use limitation and the DCL rules.
So from a practical standpoint, what do taxpayers need to be aware of with respect to these changes?
I think the main takeaway is that taxpayers who have been stuck in that kind of phantom DCL trap where they had the disregarded entity receiving disregarded income from the owner really have the pathway to get out of that scenario, since the rules now approve of intercompany transactions giving rise to income. And so I think what we've been talking to a lot of clients about is kind of moving that into another part of the consolidated group in order to bring those payments to life and get them out of that DCL trap there. And just kind of more broadly, now there's clarity on this issue. There had also been some subset of taxpayers that thought not only would you not take into account the income on an intercompany payment, but also that an intercompany payment could not give rise to a loss that would be caught by the DCL rules. And that's been put to bed now too.
Thanks, Doug. As we wrap up this episode, any final thoughts?
I think for as much as we discussed here, there's a lot more in this guidance, believe it or not. I mean, we didn't even talk on the changes to stock inclusions or the IRS trying to sort of regify a position from one of its advice memos about 15 years ago. But I think the final thought is, at least for the tax policy side, this is going to be a really interesting test case of rulemaking in the post-Loper-Bright era. A lot of the provisions that we discussed, you can sort of see where Treasury and the IRS were coming from and thinking that they were good tax policy from their perspective and wanting to move ahead with them. And they've really gotten a lot of pushback from the community about the boundaries there. So it'll be really interesting to see how this all develops.
Thank you, Doug, for the primer on the proposed DCL rules, and a special thanks to Michael Timmerman for his help behind the scenes with this episode. Although the proposed regs provide helpful guidance on the coordination of the DCL rules with Pillar 2, they create significant complexity with the addition of the new DPL regime. We'll obviously have to wait and see what happens when the rules are ultimately finalized, but in the meantime, taxpayers should become familiar with these new regs and think about structuring in anticipation of their application. As always, please stay tuned for future episodes of KPMG's Inside International Tax to stay up to speed on the latest developments in U.S. international tax. Until our next episode, take care.